Okay, let's really unpack this because for the better part of 2 years, the Federal Reserve has been the ultimate financial headwind.
Absolutely, an intentional headwind.
Their aggressive rate hikes were designed to slow everything down, making it much more expensive to buy a house, finance a car, or even carry a credit card balance.
But that's over.
We have now entered a completely different phase. The script has, well, it's officially flipped.
It absolutely has. We're launching this deep dive
Right.
based on the Fed's second consecutive rate cut, the one they delivered in November.
Right.
They shaved off another 25 basis points, so a quarter of a percentage point.
And that brings the target rate range down to what, 4.5 to 4.75%?
Exactly. And
Yeah.
our mission today is critical.
Yeah.
We are taking the dry economics of this and translating it directly into dollars and cents for you.
For the median American household, right? The one earning around $75,000 a year with a net worth hovering near, say, $192,000.
That's the focus. We've synthesized a really powerful analysis, largely based on a recent briefing by Dr. James Harrington, that connects all these moving pieces.
And what's fascinating here is the message. This cut, it follows that 50 basis point cut they did back in September.
This is the central bank signaling genuine confidence. They believe the heavy lifting on inflation is done.
And that price growth is really receding toward that 2% target.
Crucially, they're doing it while the labor market is still resilient. So they're no longer fighting inflation. They're nurturing the soft landing.
So what does this new era of easing actually mean for our listener, beyond just the promise of a soft landing?
Well, this is where the analysis provides a stunning conclusion. The net effect is, let's say, mildly positive in the immediate term, the next 6 to 18 months.
Okay, mildly positive.
But it becomes significantly positive over the next 3 to 5 years, provided we avoid recession.
And you can put a number on that, can't you?
You can. The analysis projects that the typical middle-class household earning between $50,000 and $150,000 could be $3,000 to $6,000 per year better off.
$3,000 to $6,000 a year.
By late 2025 or 2026, compared to if rates had just stayed at their peak. It's a measurable injection of financial relief.
That is a staggering number. And if you're listening, you're probably asking how. How does that $3,000 to $6,000 show up in my monthly budget?
We need to walk through it channel by channel.
Starting with the area that offers the highest immediate impact, housing and mortgages.
Absolutely. Mortgage rates are the most visible channel, and they're the most responsive to changes in Fed sentiment. I mean, think back just a year ago, October 2023.
Oh, it's so brutal.
The average 30-year fixed mortgage rate peaked near a brutal 7.8%.
Right. And today,
Just on the anticipation of these cuts, we're already down to roughly 6.6 to 6.7%. That alone has thawed some of the housing market freeze.
and that's just the starting point. So let's talk about the trajectory. What are the key market expectations driving this savings figure?
Well, the current forecast, which underpins that $3,000 to $6,000 projection, it assumes the Fed delivers another, say, 75 to 100 basis points of cuts.
In the coming months.
Exactly. And if that happens, we should see the 30-year fixed rates settle consistently in the 5.75 to 6.25% range by mid-2025.
That 6% target, that's the real aha moment for anyone looking to buy a home or even just move. Let's quantify it. Take a standard $400,000 mortgage.
Okay. So at a rate of 6.8%, which was still common earlier this year, your principal and interest payment is about $2,611 a month.
$2,611.
But if that rate drops to 6% as projected, the payment falls to $2,398. That's a saving of $213 every single month.
Wow. $213. I mean, that's not a rounding error. That's a full weekly grocery run or covering the rising cost of utilities.
Annually, it's $2,556 saved.
And that $2,500 annual saving for our median household is basically like getting a clean 3.4% pay raise just from interest costs.
That's the power of monetary policy easing right there.
Okay, but I want to push back on that a little bit. That sounds fantastic for a new home buyer. But what about all the people who felt locked in over the last 2 years? Does this benefit them?
That is an essential question because the refinancing opportunity here is the real economic booster.
Okay.
Think about the millions of people who had to buy or refinance when rates spiked in 2022 and 2023. We're talking more than 7 million households sitting on mortgages at 6.5% or higher.
The so-called 7% vintages.
Exactly. They didn't have a window to refinance before, but they're absolutely getting one now.
And the expectation is that a lot of them will take it.
The analysis says 3 to 4 million of those households will successfully refinance in 2025 and 2026. This isn't just theory. It's a huge amount of capital freed up.
How large is that aggregate economic impact, just from the refinancing?
Well, collectively, if those 3 to 4 million households shave off just 1 percentage point from their mortgage rate, the sources estimate it pushes $10 to $12 billion annually back into the economy.
As fresh discretionary spending.
Right. That is why housing is the single biggest determinant of these short-term financial gains for the middle class.
Okay, let's move beyond the huge outlay of a home. Where else does this rate relief start showing up? I'm thinking about other kinds of debt.
Consumer credit, auto loans.
We saw some truly brutal numbers on new car financing.
We certainly did. New auto loan rates peaked around 9.7% in November of 2023. That just felt punitive.
And the good news?
They've already come down to the 7.9 to 8.1% range, and if the Fed follows through, we should see that rate push towards 6.5 to 7% by summer 2025.
Let's run a typical transaction. Cars are getting more expensive. Let's say you finance a $48,000 vehicle, which is about average over 72 months. What's the difference?
Okay, if you bought that vehicle at 9.5%, your monthly payment was $865.
$865.
If you can get a 7% rate in mid-2025, that payment drops to $813. That's a difference of $52 per month.
$52. It might feel small compared to the $200 from the mortgage, but over 6 years, that adds up.
It's about $3,700 in total interest savings for that single buyer over the life of the loan.
And then there's credit card debt.
Yes. We also have to factor in relief for the 45% of households that carry a revolving credit card balance. The average balance is sitting around $6,500.
And most of those cards are priced against the prime rate, which moves with the Fed.
In lockstep. So the 75 basis points of cuts since September, plus the ones we anticipate, are already taking the edge off.
How much cash does that translate to?
For someone carrying that $6,500 balance, you're looking at an interest expense drop of about, say, $50 to $65 per year.
Again, that sounds modest individually.
It is. But when you scale it up, that aggregate number becomes massive.
Of course.
The sources estimate this aggregates to between $15 and $20 billion in annual relief for consumers. It's a significant liquidity injection, and it disproportionately helps the families who are the most financially stressed right now.
This whole discussion has been about the cost of debt. Hugely important. But now we need to shift because the single most important long-run effect is actually about income growth, the labor market.
This is absolutely critical, and it's what separates this cycle from past easing attempts.
How so?
Historically, when the Fed tightens aggressively, like they did, wage growth eventually crashes. We saw nominal wage growth cool from a peak of, 6.7% in 2022 down to around 4.2% today?
Which was necessary to fight inflation.
It was. But the unemployment rate is still remarkably low, 4.1, 4.2%. The key distinction here is that the Fed is easing preemptively.
They're not cutting because the economy is in a ditch.
They are cutting specifically to preserve this strong labor market, not kill it.
And there's historical precedent for this being a powerful lever.
A rare one, but yes. If you analyze previous cutting cycles, the 1960s, the soft landing in the 90s, even the mid-2010s, when the Fed cuts while unemployment is below 4.5% and inflation is moderating, real wage growth for workers tends to accelerate 12 to 24 months later.
That soft landing scenario is the dream, but we have to remember how often economists predict that, only to see a recession follow. What gives us confidence this time could be different?
It's the combination of the preemptive action and the measure of sustained wage pressure. The analysis points to the Atlanta Fed wage growth tracker,
Right.
which is key because it only tracks continuous workers. It gives a cleaner measure of true wage pressure, and that tracker is currently running at 4.8% nominal.
And the goal is just to stabilize that number, not let it fall off a cliff.
Precisely. The goal is for wage growth to stabilize in the 4.5 to 5% range. That avoids the 3 to 3.5% slump we saw in previous cycles.
So if inflation falls and nominal wages stay strong,
That is the definition of sustained, strong, real wage growth. And for the bottom 50% of the working population, This income stabilization is the single most important wealth-building channel they have. It dwarfs the impact of any stock market rally.
That is a powerful point. It shifts the whole focus. Now let's cover the secondary effects, starting with the one that's been overwhelmingly positive for retirement accounts, the stock market.
The market certainly loves rate cuts, doesn't it?
Hmm.
We've already seen a powerful anticipatory rally. Since the September cut, the S&P 500 is up roughly 12%,
And the tech-heavy NASDAQ is up even more.
about 15%.
And we can quantify the immediate wealth effect of that. The median 401k for someone aged 45 to 54 is about $250,000. A 15% rally on that is.
It's a gain of roughly $37,500, added to that balance in a very short period.
And that's the direct accounting benefit, but there's a behavioral piece too.
Right. Dr. Harrington's briefing points to Fed research on the wealth effect. It notes that every sustained 10% rise in equity prices adds about 0.3 to 0.5% to overall consumption growth in the following year.
So people feel richer, so they're more willing to spend and invest.
That confidence matters for the roughly 60 million American households that own equities, usually through these retirement vehicles.
Okay, so that's all the good news. Lower debt costs, stronger real wages, rising retirement accounts. But in any cycle, there is a main negative channel, and we have to acknowledge it.
The pain point.
Fixed income retirees and households who are heavy in cash savings.
This negative impact is absolutely real. This is where the benefits are reversed. High-yield savings accounts, which were giving savers, 5.3 to 5.5% at the peak?
Yeah.
They've already dropped to the 4.6 to 4.9% range. And the projection is they'll settle around 3.75 to 4.25% by the end of 2025.
For certain retirees, that is a severe blow. Let's translate that loss for someone who deliberately holds a lot of cash. Say a household has $500,000 sitting in cash or FDIC accounts.
At 5.3%, they were earning $26,500 a year, just from interest.
26.5.
If that rate drops to 4%, they're now earning $20,000. That is a real $6,500 annual loss in liquid income. It can certainly strain budgets for that specific group.
And that $6,500 annual loss directly offsets the $3,000 to $6,000 gain we projected for the middle-class borrower. But how broadly is this pain felt across the whole retiree population?
The broader context is crucial here. The sources confirm that only about 8 to 10% of total retiree income generally comes from interest. Social Security, pensions, dividends. Those are the dominant protected income streams for most. So the negative impact is highly concentrated among that specific group of upper-middle-class retirees who made a strategic choice to over-allocate to cash.
So if we weigh the gains against those concentrated losses, the analysis suggests the positive channels are just significantly broader.
That's the balance sheet view, yes. The potential gains are distributed across the 70% of households that borrow, work, or hold retirement accounts.
So let's look at the wildcards. What determines if we actually realize this $3,000 to $6,000 gain?
Well, the primary green light comes from inflation expectations. The good news is the University of Michigan long-run expectations have fallen a lot, from 4.5% in mid-2022 to a very stable 3% today.
And that gives the Fed the room to maneuver.
The critical room. And that leads to the base case scenario for success. It's a steady, gentle path.
What does that look like exactly?
The Fed executes 3 or 4 more 25 basis point cuts in 2025, pauses around a target rate of 3.5 to 3.75%, and crucially, core PCE settles in the 2.1 to 2.3% range.
And if that happens,
We see the first sustained period of real income growth for the bottom 50% of Americans since 2019.
but there is always a crucial wild card, a risk that could derail the whole thing,
There is. The sources assign a 25 to 30% probability to this risk.
which is
The labor market simply stays too strong, and maybe shelter inflation reaccelerates. This would force the Fed to pause its cutting cycle earlier than planned.
okay.
If they pause, mortgage rates stop falling around 6% and real wage growth fades. And then ordinary Americans lose both the housing relief and the long-term income gains.
So summing it up, the analysis strongly leans toward the dominance of positive forces for the average household. Lower housing costs, cheaper loans, and preserving the strong labor market.
That's the final tally. The median household, the borrower and the earner, they will be $3,000 to $6,000 per year better off in the medium term. The losses are real, but they are focused on a specific subgroup. The benefits are much more diffuse.
And the final assessment from our sources is clear. The Fed has successfully shifted from a policy that was, necessarily punishing Main Street to one that is now rewarding it.
It's a profound shift. And this cutting cycle, if they achieve the soft landing they're aiming for, is potentially one of the most broadly pro-middle class policy moves we've seen in decades.
It all comes back to that hinge point you mentioned.
The preservation of strong, real wage growth. Everything hinges on that.
Which raises an important question for you, the listener, to mull over. We detail that risk scenario. If the labor market remains so resilient that it threatens the inflation target, how long can the Fed afford to keep cutting?
What's the signal that the soft landing window has closed?
Will it be the unemployment rate spiking above, say, 4.8%? Or will it be core PCE reaccelerating past 2.3%? Keep an eye on those two numbers because they determine whether that $3,000 to $6,000 gain actually materializes.